a lot of these countries, they already had access to gold in many cases. They often use local real estate as a kind of a placeholder for value, something more scarce than the local currency. And Bitcoin and stablecoins mainly have the advantage that over a video call or a DM or even transferring value through borders, there's greater density and ease of access there. And so the biggest losers are the ones in those countries that don't transfer over to better monies once it becomes available for them to do so. This is the third quote unquote bubble that has been in the kind of the public realm, with the prior ones, the prior bull markets being kind of sub-public level. And people can't really ignore things more than 3 times. I think that's kind of the magic number where it's not an accident, it's not a fluke. Maybe I should actually pay attention to this thing.
The global financial system stands at a pivotal moment, with $18 trillion in dollar-denominated debt, much of it concentrated in emerging markets. The strength of the US dollar carries profound implications. When the dollar rises, it puts immense pressure on these economies, forcing hard monetary decisions. But if interest rates begin to fall, the landscape could shift dramatically. Could we witness a BRICS-led boom, surging energy prices, and a revival across emerging markets? Lyn Alden also points to a key macro dynamic: the inverse relationship between real interest rates and scarce assets like gold and Bitcoin. As real yields decline, hard assets tend to rise, a pattern that could define the next global financial cycle. And before that, be the one who says, I was here before 100K. I'm on a mission to hit 100,000 subs before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comments. Let's grow and win together.
There's still a hawkishness behind the dollar. So there's a lot of developing countries out there that have dollar-denominated debt. It's something like $18 trillion in dollar-denominated debt. I think of which 13 is like held by non-banks and the rest is held by banks. That's in developed countries, that's in emerging markets, it's kind of all blended. That's part of the Eurodollar system. And all of that represents inflexible demand for dollars. So when the dollar gets kind of strong, it squeezes them. If we do get a much lower interest rate on the dollar, that allows a lot of those other countries to ease their monetary policies as well, because they're not kind of struggling against that strong dollar as much. You potentially get kind of a BRICS boom, or like an emerging market boom cycle. You potentially get higher energy prices from that. Right now, because of the more sluggish global economy, it's one of the factors keeping oil prices pretty much in line. And so that's another factor that can kind of happen. And then at the conference, I highlighted that gold and other scarce assets tend to have this inverse relationship to real rates historically, which is, if U.S. money supply is growing at 7 or 8% per year, most people aren't looking at that. They're looking at CPI, but still, it's growing at a pace. If they feel like they're getting paid 4 or 5%, they're more willing to hold on to that, especially in this kind of regulated environment they operate in. But if they're getting paid 0, 1, or 2%, and that money supply is still growing, they're more likely to get into gold or in our case, Bitcoin. And so even if we get this kind of low interest rate environment and deficits slow down a little bit, that's still really good for the assets that I'm talking about. And so that's kind of the wonderland snare we're in now, whereas higher interest rates have one mechanism of accelerating this, and lower interest rates have another mechanism of accelerating this, because it's kind of less of a free lunch now than there was during the structurally declining interest rate environment. Stablecoins is that it's less, I view it less about getting the number of dollars out there. It's partially, it impairs in some ways the exchange rate between the dollar and other currencies, and kind of the thing that can happen is, let's say you have this kind of country with an increasingly impaired currency. It's a developing country. It's got, say, 20% dollar backing for its currency. Early adopters that, say, previously had trouble getting into dollars due to border restrictions and other things and bank restrictions, to the extent that stablecoins allow them to get into dollars more than they previously could, earlier adopters that do that benefit, because as people get out of that local currency and get into a more backed version of the dollar, the other ones potentially are the ones that are transferring purchasing power to the ones that got into stable coins earlier. Now, the same is true for Bitcoin. The same is true for any other scarce asset. And it just so happens that currently the biggest two ones, Bitcoin and stable coins, are ones that give more access to a lot of these countries than other that they previously didn't have. So a lot of these countries, they already had access to gold in many cases. They often use local real estate as a kind of a placeholder for value, something more scarce than the local currency. And Bitcoin and stablecoins mainly have the advantage that over a video call or a DM or even transferring value through borders, there's greater density and ease of access there. And so the biggest losers are the ones in those countries that don't transfer over to better monies once it becomes available for them to do so. People can see one or two bubbles and dismiss them. So if they see kind of Bitcoin rise and collapse, like, oh, the bubble's dead, they don't necessarily go look at the log chart and see that there's been a couple bubbles. They only can really often know the bubbles that they saw. And the first really public bubble was 2017. Then there's the whole second bubble, but then people could be like, well, that was COVID, that was the money printing thing. So we got this kind of second aftershock, and people were able to dismiss that. But now it came up a third time. So this is the third quote unquote bubble that has been in the kind of the public realm, with the prior ones, the prior bull markets being kind of sub public level, and people can't really ignore things more than three times. I think that's kind of the magic number where it's not an accident, it's not a fluke. Maybe I should actually pay attention to this thing. That's certainly what happened to me. Just forward it a little bit. Like I would see Bitcoin have a cycle, one of its early cycles, and say that's neat, it's cool. And then I kind of forget about it, and then it has like another bigger cycle, and I'm like, oh, that's actually still here. And then it kind of goes through a bear market, and it goes to the third cycle. I'm like, okay, I'm not going to mess this one up. So I finally figure it out, and I think that's the important thing, is that's now basically happening in the public realm, where we now have three cycles that are all relatively public.
We're diving into fiscal dominance, the concept that soaring U.S. deficits and mounting interest payments are reshaping the economic landscape. In this new paradigm, the old playbook of monetary tightening may no longer hold. This is a breakdown of Lyn Alden's latest analysis, essential insight for anyone trying to navigate today's volatile markets. Let's get into it.
I think the problem is that there's so many things that people kind of have to get, like the hurdles they have to go through to get that. One is like, can digital things have lasting value? That's one of the hurdles people get through. Another one is, okay, so if digital things can have value, what prevents all of these from having value and depleting the supply? So then they have to kind of see why network effects and self-reinforcing scalability really matter. And then they have, so there's like a number of steps that people get through. I mean, that's partially why we both do what we do, is to kind of educate and share what we research along the way, to try to be part of this information trend. So as information gets more, easily out there, it still relies on people doing work, doing research, and sharing it with others, to say, here's what's happening. Here's, okay, here's arguments I'm seeing. Here's answers to those arguments. And over time, people get it. And I started using the phrase "nothing stops this train," I believe around early 2023 or so. And that was because we went through this very, very brief window where we had a narrow fiscal contraction. So in 2020, 2021, that was like the crazy money printing years. 2022 is when they really tried to hawk it up. They tried to, they raised interest rates. Most of the kind of the pandemic era programs were like dialed back to some extent. And so we saw this contraction in the broad money supply. We saw this contraction in private credit. We saw this reduction in public deficits. But by kind of late 2022 or early 2023, as public interest expense ramped up, federal interest expense on the debt, we actually started to get rising deficits again, even though they were still trying to be hawkish. And so that's when I kind of emphasized that we are entering like kind of another cycle now of where fiscal's leading again, less explosively than that whole 2020 and 2021 period, but more persistently, in the sense that it's not tied to any one catalyst. It's not this like one thing that's happening. It's back to the broader trend now on steroids. And so my key kind of emphasis was kind of fading some of the disinflationary themes or even some of the recession themes, and instead emphasizing that when you're running 6 or 7% deficit of GDP, that's a pretty different investing environment and a different economic environment than many people are used to outside of a recession, and that has all sorts of implications. So I've been kind of pounding the table on the power of fiscal, before the pandemic, during the pandemic, and now even recently after. that whole period. Yeah, a lot of these things are happening together, which is why it's so persistent. It's a really big Gordian knot, and that's why I keep fading any attempts that they're gonna, claiming that they're gonna get back on track. I mean, earlier this year and kind of late last year after the election, there was this big idea that Doge and Elon Musk are gonna get this back on track, and I was just looking at the math that's saying it's almost impossible. There's very little that they're going to be able to tackle that will actually get this back on track. So one, demographics. Basically, for decades, the baby boomer generation, which is very big, was paying into the system, and now that they're effectively retired and increasingly retired as the years go on, as even the youngest baby boomers start to retire, they're now in big drawdown mode. And so over the next 10 years, the existing $3 trillion in the Social Security Trust, which is held by intra-government debt, it's kind of the wonky accounting that they do, but that's going to basically pour back into the economy and transfer to external debt. And that's spendable income that enters the broader circulating economy. Then there's the interest expense. So, like you said, for 40 years, we had rising debt to GDP but falling interest rates. And right around the same time the demographics started to roll over, we hit zero interest rates, bounced off zero. And now we have rising debt to GDP, but no longer declining interest rates. So you don't even have to assume that interest rates are going to go up. If they just kind of chop around sideways for the foreseeable future, interest expense starts becoming a very meaningful percent. It just passed defense. It's now like the biggest component after Social Security. And if it keeps going, it'll eventually pass even Social Security. Defense spending as a percentage of GDP was falling for a while as we kind of exited the Cold War. But a lot of things, the kind of theme is things don't have to ramp up rapidly. Just if you have a mild trend change, that can really matter.
Alden's final warning is clear. This trend isn't slowing. Whether it's through inflation, currency instability, or debt monetization, the system increasingly favors non-fiat stores of value. Assets like Bitcoin and gold are positioned to benefit in this new environment. The big question now, could Bitcoin eventually rival gold as a global reserve asset? Don't miss the next key trend. Tap the video now.